In today's world, where financial security is a top priority for most families, investing wisely has become an essential tool for building wealth and ensuring long-term stability. As a parent, you likely want to create a solid financial foundation for your children, one that not only covers immediate expenses, but also ensures their future is secure. But with so many investment options available, choosing the right one can be a daunting task. If you're new to investing or prefer lower risk strategies, this speech will guide you through some of the most reliable low risk investment options that every parent should know about. One of the key principles of investing is understanding your risk tolerance. High risk investments, like stocks or cryptocurrency, may offer high rewards, but they also come with the possibility of significant losses. As a parent, it's crucial to prioritize safety and stability when choosing where to allocate your hard-earned money. Thankfully, there are plenty of investment vehicles that are not only low risk, but also provide steady returns over time. Let's start with one of the most popular and safest investment options, high yield savings accounts. These accounts are offered by most banks and credit unions, and they typically pay a higher interest rate than a regular savings account. While the returns may not be spectacular, they are safe, liquid, and virtually risk-free. For a parent, this means you can park your money in a high-yield savings account and still have access to it when you need it, all while earning some interest. The best part, your principal is always safe, and the returns are predictable. Another great low-risk option is certificates of deposit CDs. A CD is a type of savings account where you deposit your money for a fixed period, typically anywhere from 3 months to 5 years, and earn a fixed interest rate in return. The longer you commit to keeping your money in the CD, the higher the interest rate usually is. Because the rate is locked in, you won't have to worry about market fluctuations affecting your returns. While your money is not as accessible as it is in a high-yield savings account, a CD offers guaranteed returns, making it a secure choice for conservative investors. If you're looking to save for a child's future education, you should consider 529 college savings plans. These plans are designed specifically for saving for education expenses and offer a range of tax advantages. The funds you contribute to a 529 plan grow tax-free, and if used for qualified educational expenses, withdrawals are also tax-free. Many 529 plans invest in low-risk mutual funds or ETFs, which provides solid returns while minimizing volatility. As a parent, investing in a 529 plan gives you a way to save for your child's future without worrying about paying taxes on the earnings. Additionally, many states offer tax deductions or credits for contributions, making this a doubly advantageous option. For those who are comfortable with a slightly higher level of risk but still want to avoid major market fluctuations, bonds can be a good choice. Bonds are essentially loans you give to corporations or governments, which promise to pay you interest over time and return your principal when the bond matures. U.S. Treasury bonds in particular are considered among the safest investments, backed by the full faith and credit of the U.S. government. Municipal bonds issued by state and local governments are also relatively safe and can offer tax advantages, especially if you live in the state where the bond is issued. While bonds generally offer lower returns than stocks, they are also less volatile, making them a good choice for risk-averse investors. In addition to individual bonds, you might also consider bond mutual funds or bond ETFs, exchange-traded funds. These funds pool together multiple bonds, giving you exposure to a variety of debt securities, which helps spread risk. Bond funds are also liquid, meaning you can sell your shares at any time. They can provide regular income, typically through interest payments, and because they invest in bonds, they tend to be much less volatile than stock funds. Another low-risk investment strategy that is gaining popularity is real estate investment trusts, REITs. REITs are companies that own and manage a portfolio of income-producing properties, such as office buildings, apartments, or shopping centers. By investing in a REIT, you can gain exposure to the real estate market without having to buy and manage properties yourself. Many REITs focus on stable, income-generating properties, making them a relatively low-risk option. In addition, they often pay regular dividends, providing a steady stream of income. Although there is some exposure to the real estate market, REITs offer a way to benefit from real estate without the hands-on management and substantial initial capital required for direct property ownership. If you are looking for a low-cost, diversified option that requires minimal effort to manage, you might also consider investing in index funds. These funds track a specific market index, such as the S&P 500, and invest in all or a representative sample of the companies that make up that index. The goal is to match the performance of the market as a whole, rather than trying to beat it. Because index funds are passively managed, they typically have lower fees than actively managed funds. Over time, they provide steady growth with minimal risk compared to individual stocks, making them a great option for parents who want a simple hands-off investment. Lastly, let's not forget about Roth IRAs and traditional IRAs. While these are technically retirement accounts, they can be a valuable tool for parents who want to invest for the future while enjoying tax advantages. A Roth IRA, for example, allows you to contribute after-tax money and then withdraw it tax-free in retirement, including any investment gains. IRAs can be invested in a variety of low-risk assets, such as bonds or dividend-paying stocks, and they provide a way to grow your wealth while securing tax benefits. Additionally, the earlier you start contributing to an IRA, the more time your money has to compound, making it an excellent long-term investment. Before making any investment, it's important to assess your financial goals, your time horizon, and your risk tolerance. As a parent, it's natural to want a secure future for your children, and that often means taking a cautious approach to investing. By focusing on low-risk options, you can minimize the chances of losing your money while still achieving steady growth over time. Whether you choose high-yield savings accounts, CDs, bonds, REITs, or mutual funds, there are plenty of options that can provide financial security for your family. Ultimately, the key to successful investing is consistency. Even if you can only invest small amounts at first, starting early and contributing regularly will pay off in the long run. And remember, it's always wise to consult with a financial advisor who can help you choose the right investment strategy based on your unique needs and goals. By taking a thoughtful, low-risk approach, you can create a brighter, more secure future for your family, one investment at a time. High-yield savings accounts and certificates of deposit, CDs, are two of the most straightforward and low-risk investment options available to parents looking to grow their savings with minimal exposure to risk. While they might not offer the rapid growth potential of stocks or other higher-risk investments, they provide a stable and reliable way to build wealth over time, especially for parents focused on security and ease of access. A high-yield savings account is essentially a regular savings account that offers a significantly higher interest rate than what you'd find in a traditional savings account. The key benefit of a high-yield savings account is its accessibility and liquidity. While the returns aren't as high as you might see from more volatile investments, your money is guaranteed to grow at a predictable rate, and you can withdraw it whenever you need it. This makes high-yield savings accounts ideal for emergency funds, short-term savings goals, or parking money that you don't want exposed to market fluctuations. The interest you earn is usually compounded, meaning you'll earn interest on both your original deposit and the interest already added to your account, leading to steady growth over time. Certificates of deposit, CDs, are another great option for those looking to keep their money safe while earning a return. When you invest in a CD, you agree to leave your money in the account for a set period, anywhere from a few months to several years. In exchange for this commitment, the bank offers a fixed interest rate that's often higher than what you'd get from a regular savings account. The downside is that you won't be able to access your funds before the CD matures without paying a penalty, but the trade-off is a guaranteed return and a virtually risk-free investment, making CDs ideal for parents who can set aside funds for a specific goal and don't need immediate access. 5029 college savings plans and bonds are two reliable options for parents who want to invest for their children's future education while maintaining a low-risk profile. Both provide a way to grow wealth over time, offering tax benefits and relative security compared to more volatile investment choices. A 52-9 college savings plan is specifically designed to help families save for educational expenses. The money you contribute grows tax-deferred, meaning you won't have to pay taxes on the earnings as they accumulate, and when you withdraw the funds to pay for qualifying education expenses, such as tuition, books, and room and board, the withdrawals are tax-free. This tax advantage makes the 529 plan one of the most attractive ways to save for a child's education. There are two main types of 529 plans, the college savings plan and the prepaid tuition plan. The college savings plan allows your investments to grow in mutual funds or ETFs, offering potential for growth, but with more variability depending on the market. On the other hand, prepaid tuition plans allow you to lock in tuition rates at today's prices, reducing the risk of future tuition hikes. While investing in a 529 plan does involve some market risk, it's typically lower compared to other equity-based investments, and it's specifically designed for the long-term goal of funding education. Bonds, especially U.S. Treasury bonds or municipal bonds, are another low-risk investment strategy for parents looking to save for the future. Bonds are essentially loans you make to governments or corporations in exchange for regular payments and the return of your principal at the bond's maturity. U.S. Treasury bonds are considered one of the safest investment vehicles because they are backed by the federal government. Municipal bonds issued by state and local governments can also offer tax advantages, particularly if you invest in bonds from your home state. While bonds generally provide lower returns than stocks, they are much less volatile, making them an excellent option for conservative investors who prefer steady income over higher risk. Index funds and real estate investment trust REITs are two low-risk investment strategies that offer parents a way to grow their wealth in a manageable, hands-off way without the need for specialized knowledge or constant monitoring. Index funds are a type of mutual fund or exchange-traded fund, ETF, that track a specific market index such as the S&P 500, which includes 500 of the largest publicly traded companies in the US. The primary appeal of index funds is their ability to provide broad, diversified exposure to the stock market without the need to pick individual stocks. Since index funds aim to replicate the performance of the overall market, they generally come with lower fees than actively managed funds, making them a cost-effective option for long-term investors. This diversification helps minimize risk since the performance of the fund is spread across a wide array of companies rather than depending on the success or failure of a few. For parents, this means they can invest with confidence, knowing that their portfolio is aligned with the overall market's growth over time, and that volatility is typically reduced due to the wide range of holdings. Real estate investment trust REITs, on the other hand, allow investors to tap into the real estate market without the complexity of buying and managing properties themselves. REITs are companies that own, operate, or finance income-producing real estate across various sectors, including residential, commercial, and industrial properties. By investing in a REIT, parents can gain exposure to the real estate market, which tends to be less volatile than the stock market, while earning a steady stream of income through dividends. Many REITs focus on stable, income-generating properties, providing a predictable and relatively low-risk investment opportunity. This makes REITs particularly attractive for parents looking for passive income, as they don't require the time, effort, or capital investment needed to own physical property directly. Additionally, REITs are highly liquid, meaning they can be bought or sold on the stock exchange just like other publicly traded stocks, offering flexibility for investors who may need access to their funds.